Don, welcome back to F.A.C.E. I'm really interested in your presentation in light of what happened last week in the markets, and want to talk about if we're in this rainmaker scenario. I just passed you the controls. Everyone, welcome Don Meade at 7 Sentinels is his Twitter handle. There you are. See his handle up there. Okay, waiting to hear your voice, see your screen.
Can you hear me?
Got you, Don.
You can hear me?
Yeah, very loud and clear, my trading warrior brother. How are you today?
Super, Dale. Really good to be with you, and I'm very honored.
Yeah,
Thank you very much.
Great to have you back. You know, I love your handle. You know, sentinels are guards, and you know they protect things, and you know your sentinels are technical conditions of the market, and I'm interested. I sent you a tweet. You said that the whole crew is AWOL right now after the declines we saw last week.
They are indeed.
All 7 of them are out chasing women around somewhere.
I guess they are. They are.
Okay, so go ahead.
Well, by the way, the reason I came up with that name, 7 Sentinels, is that I've been a great fan of Jesse Livermore my whole trading career, which spans back several decades. And Jesse's #1 concern or philosophy with regard to markets is just simply that there aren't bear markets or bull markets. Well, let's put it a different way. There isn't a bull side or a bear side to the market. There is only the right side to the market. And the right side to the market, he called the line of least resistance. So I set about for years and years to find a number of sentinels, if you will, that would tell me what, at any given time, the line of least resistance truly is. Because if Livermore is right, and your objective is to trade with the line of least resistance, I wanted to find a way of identifying the line of least resistance, and I ultimately did so about 10 years ago with my 7 Sentinels. So that's the history of that.
Okay, and why is the number 7? That's a number of completion. Any reason for 7?
That's actually a good reason to use 7, completion. Okay. I just found that by putting these 7 together, I had essentially completion, if you will, of the accurate description of the trend of the market. No particular reason for 7. It just worked out that way.
Okay, yeah, it's a lucky number. All right, so you know, I'm sure after last week, Don, there are a lot of people saying, "No, you know, it's another dip to buy," and you know, the candles on the weekly for me, especially in the NASDAQ 100, was pretty damaging. Hard for me to see how we're gonna, you know, I'd be very surprised to take out last week's high. So show us what you're looking at and what the Sentinels are saying, and make your case.
Oh, you betcha. Thanks, Dale. You know, King Solomon said several thousand years ago in the book of Ecclesiastes that there is nothing new under the sun. Then a few thousand years later, a young...
but Don, didn't he also say that men toil under the sun for nothing?
He certainly did. He certainly did.
We could replace the toil with trade, but
That's
we
right.
don't do it. Okay, go ahead, buddy.
Well, several thousand years later, a young speculator by the name of Jesse Livermore said that Wall Street never changes because human nature never changes. And what he was saying is that markets have never changed, will never change, and will always react in the same way because human nature never changes. And this is basically what King Solomon was telling us thousands of years ago. I think maybe the best, I should tell you before we get started that right at 6:30 when the market opens, I have to place some trades. So we'll
Okay.
kind of speed through this and make sure that we get done in that period of time. But at any rate, let's take a look at, let's go back to the year 2000, since we're talking about markets never changing, markets repeating. By the way, I would say, Dale, that you and I have a job simply because of the truth of that factor. If it weren't for the fact that markets never change, you and I would never have been able to come up with what we do, which is to identify patterns in the market, to identify recurring patterns, and to be able to then project what is going to happen in the future based on the recurrence of those same patterns again and again and again. Nothing is new under the sun. But at any rate, let's go back to the year 2000. Here is the year 2000 for the Standard & Poor's 500, right from January up to October. And notice that the Standard & Poor's 500 made a high early in the year, in this case in March, at around 1526. They went into a nosedive and then worked their way higher all year long, and then poked their head up above that 1526 on the first day of September 2000. Now, notice this. Look at what the advanced declines did in that same period of time from early 2000 to September of 2000.
Yeah, price almost at new highs and AD maybe halfway back.
Substantially lower, exactly right.
All right.
Also, the number of new lows. Well, we'll get onto some of the other things. The McClellan oscillator was substantially lower. The percentage of stocks that were in point and figure buy patterns was substantially lower in September. And that was true on the NASDAQ as well as on the New York. But at any rate, let's jump forward now to the year, well, since I see what just popped up here. Here's a larger view of that March 2000 top, September 2000 retest with much weaker internals, and here's what followed. For the next 2 years, the market dropped like a stone. It dropped in half. And it's because we had that setup from early 2000 into the fall of 2000. Now let's skip forward to the year 2018, this year, and here is, in this case, I used the industrial average just because I was doing some other work with the industrial average when I did this particular chart. But here is the industrial average making a new high in late January. It actually peaked on January 26, 2018. Made a high it had never seen before, and that was an all-time high. And then the market came down just like it did in the year 2000, worked its way higher, and finally made a new high in October, early October 2018, this month. And notice again, the advanced decline line has already peaked back in August, and as it made a new high, it was substantially lower. The number of new highs came steadily down. The number of new lows grew as we came up to that new high. Here is the New York Stock Exchange high minus lows on a 10-day average, the net new highs. They were 250 back in January of 2018, And
these internal studies are your sentinels.
no, these aren't my sentinels, but my sentinels are very similar to these.
Okay.
They are.
These are standard. These are standard. Everyone looks at these.
Yes.
Okay.
So in October, the number of the net new highs on a 10-day average had fallen from plus 250 all the way down to around 80 at that October 5th peak this last week. Same thing for the McClellan oscillator summation index. It had dropped from 750 down to about 0. It's going to be minus today. It'll be below 0. Same thing with the percentage of stocks on the NASDAQ that are making point and figure new buy patterns. That number was 70% back in January, and it has fallen all the way now to 49%, less than half of all NASDAQ stocks, are in buy patterns. Same thing with the New York Stock Exchange buy patterns, the BPNYA, which is again the percentage of stocks that are making point and figure buy patterns, that has fallen dramatically. Same with the number of stocks over their 200-day average has fallen dramatically over the balance of the year, and so has the number of stocks over the 50-day moving average. And you can see what the Russell 2000 has done just now in the last 5 or 6 weeks. It's dropped 8%. So what has happened is, as the market came up and retested the old high that it had set on January 26, 2018, all of the internals were very substantially lower. So that is really the picture we're looking at. We're looking at a market that has internally been falling. The way I look at this market is that it actually peaked not on October 5th, 2018. It peaked, it peaked between about November of 2017 and, like you say, February of 2018. That's where the real peak was in the market. This is our weekly market analysis, which went out yesterday, or which we posted yesterday, and people read then. And in that, we showed what has happened to the market just in the last 2 days. 2 days, yes. We have the Dow achieved its nominal new high closing of 26,828 2 days ago on October 3rd, 2018. And look at the technical damage that has been done just in the 2 days of Thursday and Friday after that new high. The advanced decline line, as we showed, has dropped dramatically. The number of new lows has actually grown to, on Thursday and Friday, they averaged over 400 new lows per day. Now think about that for a moment, Dale. Of all the stocks that trade on the New York Stock Exchange every day, which is just over 3,000, 400 of those issues broke through their lows and made new lows, new 12-month lows on Thursday and Friday. And that's just, that's 13% of the entire list, and that's just 2 days off the all-time high.
How far back is that other red bar? That's
this one right here. That was what happened after the January 26th high.
Okay. All right.
So this is a 1 year period of time. Thank you for putting this a little bit more in perspective, and that is what we are looking at the last year. Here are the net new highs, having dropped from just a month ago about 80 net new highs a day, or in January we were having 250 net new highs per day. Now we're at negative 130 net new lows per day. And I could go on and show you each one of these individually, but the point is that the damage that has been done in the market in the last 2 days is almost immeasurable. And we can quantify it, and I have, and those statistics are in the report that I wrote yesterday. But when I say immeasurable, I mean that it's hard to even quantify how badly this market has taken it on the chin and what that's going to mean for the market looking weeks ahead.
Is there anything in your methodology that would give you targets or objectives after you identify that we're in a weak period? You know, how much of a decline should your subscribers be looking for? Because you know, you never go broke taking profits. So there are probably some levels as well where you might be willing to lighten up on shorts.
Yes, that's a very good point. The short answer to your question is no, I don't project levels. It just isn't something that I do. It isn't something that's part of my work. What I do is quantify at any given time the direction of the market. And I am always keenly aware of what the direction of the market is at any given moment based on what my 7 sentinels are telling me. And they are telling me in the most definitive, absolute way that that trend is down. Now, to though further amplify that point or answer your question just a little bit better, when you take a look at how badly the markets are diverging, how serious are these non-confirmations, you can get a feel for what's to come. The more serious the non-confirmations, the more serious are the declines in the internals ahead of the move in the market, the bigger that move is going to be. So I can say this: of the tops that we had in the year 2000 and 2007, this top is every bit as serious. And I would look for the declines over the next 2 years to be every bit as as much amplitude, right? Okay. As we saw before. So I would say at a minimum that we're going to see a 50% decline in the Standard & Poor's 500 over the next couple of years. Frankly, it can be a lot more than that because I'm seeing some serious problems with this market that are far more serious in 2007 and as serious as the year 2000, maybe more so. So we're looking for a big.
You play this through bearish ETFs, Don?
Yes,
rather
absolutely.
Than futures.
Yeah,
Why do you prefer the bearish ETFs, like the 3 times leverage ETFs over futures?
Because futures give you unlimited risk. If you're short a future, there's no limit to how much that can go against you. You can protect yourself with stops, but the overall risk is unlimited.
Yeah, I'd rather be wrong for a week in SQQQ than NQZ.
Right, exactly. You got it.
I hear you. Okay.
And options, I love options. In fact, I'm looking to buy some options here in about 10 minutes when the market opens. But some put options. But options have the disadvantage of having deteriorating time value. And if your timing isn't just precise, that deterioration is just going to kill you. Right. So those are the 2 big disadvantages. I like leverage. Leverage is a wonderful thing. But if you're shorting, by the way, if you short the market with a margin account, you have 2-to-1 leverage, but you have to go in and borrow those shares every time you make a trade. That's a big hassle, and it slows your way down, and you don't know if you're going to be able to borrow them. You don't have that problem with ETFs. So that's it. All of the alternatives to giving you leverage in the market have downfalls that I don't like. ETFs don't have those downfalls, and that's why I prefer to trade them.
Where do you think I had to chuckle a couple of weeks ago, Don, one of the anchors at CNBC, when the Dow was down and the S&Ps were down, but NASDAQ was ripping, said that investors were buying the FANG stocks as a flight to safety trade.
Right.
And anyway, are there any other places to hide and go besides being short the market during time periods like this that you pay attention to?
Not that I pay attention to. I'm just a pure market trader,
okay.
and for that reason, I really can't answer your question.
It only takes one.
Here's what I would say: if you're looking for alternatives, check with Dale Pinkert, because he's got plenty of them. He knows more about the metals market than I'll ever hope to know.
But well, I know you want to get set for trading in about 9 minutes. So
yes.
What do you want to wrap it with, buddy?
I guess just this. Do you remember did you watch the movie Margin Call?
No.
Oh my gosh, Dale, you have to watch it.
Okay.
It is just a phenomenal movie, and it has so many parallels to what's going on right now. But there is a scene in Margin Call when the guys that have come up with this model that tell them that the market's ready to crash are in their car. They're driving. It's early in the morning, but there are a lot of people out on the streets. And Peter Sullivan says, look at all these people wandering around with no idea about what's just about ready to happen. No idea what's about to happen. And
I said that to my wife yesterday on the way to my in-laws.
And I think about that all the time.
Yeah.
That's where we are. And the fact, though, is that it doesn't have to be that way. You don't have to be unprotected. You don't have to be in the dark when it comes to market, because the answers are there. The repeating patterns are there, and you can be prepared. And in fact, you can not only protect yourself, but you can make a tremendous amount of money from these abnormal moves, the declines.
Although both you and I have been premature at times.
True. That's okay. Absolutely true.
Okay, so but the difference is, to be there for the good times, you have to be there all the time, right?
That's right.
And keep attempting it. So, Don, what's the best way for our listeners, viewers of the video later, to reach you? I know I've given out your Twitter handle. Maybe you want to show your website.
You betcha. Thank you very much for reminding me of that. 7sentinels.com is where we are. And you can log into 7sentinels, or I should say, you can go to 7sentinels.com, and right down at the bottom of the page, you will see a number of links to articles that are available to everybody. You don't have to be a member to click on these links and read articles like.
Oh my God, When Worlds Collide, is that Planet X?
When Worlds Collide?
Planet X going to bump into Earth?
I'll tell you, worlds collided in the year 2000 when a secular bull market that had taken the Dow from 550 up to over 10,000 bumped right squarely into the onset of a primary bear market. That was a collision of markets. We had it again in 2017, 2018. It's the same thing all over again. I recommend that article, When Worlds Collide. I think there's a lot of useful information there. Another one is Red Sky in the Morning. It talks about all the warnings that have popped up over the last year, and there have been a massive amount of them, and they are the most severe warnings in history, or at least of the data that I can find studying over the last 100 years or so. Well, let's see, the line of least resistance, several good articles down there. I would say just check them out. Also, right here, limited time trial. If you click on that, for just $9.95, you can have 14 days of 7 Sentinels to take a look at it and see what impact it has on your trading. You can see we publish every day, every night, every weekend, all of our trades, all of our setups, all of our everything is right there. So
I have an interesting question from an attendee, from Ben Morgan. He said, could you ask Don if it worries him that every time we've had a pullback for the last 6 to 7 years, that these crash calls immediately come out by tons of analysts?
Sure.
Does it bother you?
Oh, yeah. Sure it does.
Okay.
I don't like saying that, but I have to go with what my work tells me, and there's always a hook in the market. I don't know if you remember Joe Granville, but he used to always,
do.
Yeah, he used to talk about the fact that there's always a hook, something that hooks people. And
he also said what's most obvious is obviously wrong.
Exactly. But he said that there's always a reason that people say, well, this time I don't quite believe it. I know everything's set up right, but we got too many people calling for a crash. That can't be right. Well, that's probably the hook. Anyway, that's what I'd say about that.
Well, Don, I want to thank you a lot for coming in. I've turned off this alarm. I don't know why it's continuing. Hold on. So I wish you this to be a rainmaker.
Thank you.
For you and all your subscribers. Good hunting, and thanks for being a watchman for people that may stay a little greedy and possibly a little too naive, a little too long.
Thank you so much, Dale. I can't tell you how much I appreciate what you do, and it's really an honor to be here with you, so thank you.
Oh, well, I'm a fan of yours, Don, as well, so good hunting. Have a great fall trading season, and look forward to seeing what kind of outcome we have. Maybe we'll get together in a few months, and for sure early next year. Okay, buddy?
Good. Would love that. Thanks.
Okay, Don. Everyone, that's Don Meade. You can follow him at 7 Sentinels with an E, not an A. So you could tell he's popular when people try and imitate him and use the same handle, only change a vowel. And you could find him at www.7sentinelswithane.com. So I'll see everyone for Turnaround Tuesday. Good hunting. And remember, don't just count your pips, count your blessings. See everyone tomorrow. Adios. Thanks again, Don.
Thank you, Dale.